Good evening and welcome to the Rex Fuels channel, where we will be discussing key issues and trends facing the oil and gas industry today. We have with us today Mr. Pranav Kanth, Corporate Development and Strategy Director of Rex Fuels. He is a veteran of oil and gas sector with over 22 years of experience with Total, BP and Apar. Welcome, sir.
Thank you, Zina.
My first question for you is, the crude oil prices have been very volatile. How do you view this?
Yes, that is the most important thing, and thanks for the question. It has been indeed very volatile. And the reason, as we all know, it began with Russia's invasion of Ukraine, which was on February 24th. And ever since, it has been on a very volatile and mostly increasing trend, with prices reaching as high as $139 per barrel for the Brent. But when we look at this week, this has seen some cooling down, with the largest decline in prices since November 21. From $139, it came down to about 112. So this has really been a very volatile week. And there are few things which are really riling the market here. One is the sanctions are taking a shape which is much more stronger than what was envisaged earlier. And when I say much more stronger, there is a voluntary sanction from most of the large oil companies in the world against buying Russian crude. And how that is important, because Russia accounts for about 7% of the crude exports in the world, and at about 700 million barrels per day. So it has a big influence in the market. While the sanctions are very wide-ranging, which is the most intensive sanctions ever. So when I say most intensive sanctions, Russia currently has more than 5,500 different kind of sanctions in place, which has been instituted by various countries in the world. This compares with Iran, which is about 3,600 sanctions, and Syria 2,600 sanctions. So that really puts in perspective as to the severity of the sanctions. Having said that, the markets are going much beyond or much ahead of when the sanctions really took place or announced. Corporates are not buying Russian crude. And the most recent example has been ONGC Videsh, which has a 20% stake in the Sakhalin oil fields. Its recent tender of 700,000 barrels went a-begging. So that's the kind of impact it is taking place, while India is not part of the sanctions. So yes, sanctions are driving the price up. But what is really working in terms of bringing the price volatility down is also the steps being initiated to ease these supply constraints. US has already initiated discussion with Venezuela, which was against the previously under the sanctions regime. So which could potentially bring in about 400,000 barrels per day of oil to the market. The ongoing discussion with Iran onto the nuclear deal could see some progress. How it pans out, it would need to be seen. But as and when it comes out, it would be a net positive for the oil supplies. While the surprising part is Europe and US are strongly with the sanctions, are enforcing it. This time, the Middle East and the China and large parts of Africa, they are having a very independent stance. So they are not really going with the US line of sanctions. So that really brings the market to a very interesting stage. So we are in very interesting times.
That's pretty interesting. My next question to you is, there have been very dire forecasts of crude touching $150 and even $200 per barrel. Where do you see the near-term prices headed to?
Most of us have our views, but frankly, none of us can really predict in these kind of volatile times. Why? Because it is driven by geopolitics of war and the international relations, which are difficult to predict and price in. The current Russian invasion of Ukraine continues, but at a very slow pace. It's difficult to price in as to how long would it last and to what degree it would lead to in terms of the fate of Ukraine, whether it remains as a singular unity or it gets fragmented. So all those questions are difficult to predict. So that is at the core of it. Secondly, and more importantly, what this is leading to is kind of two different groups of pro-sanctions and not really interested in sanctions. So the US and the Russia and large part of the Latin is part of the sanctions group. But within the Americas, Mexico is not part of the sanctions. The whole of the Middle East, including Saudi Arabia and UAE, which are amongst the biggest stakeholders when it comes to the crude supplies, they are maintaining their independent stance and they have not condemned it. And matter of fact, it is very interesting to see UAE and Saudi taking a very independent stance. And as part of the OPEC plus, Russia is part of the OPEC plus. So they seem to be, UAE and Saudi Arabia, they seem to be more aligned with the Russia. And of course, the biggest factor is China, and China happens to be the closest supporter of Russia. It has stayed very neutral and independent, and one could say supportive of Russia. So all these things lead us to a kind of situation where we don't have any historical precedence to the kind of situation which is evolving. There are larger questions being talked about as an alternative to SWIFT. So if that could take place, although these are more speculative and this could be some distance away, but the trade between China and the Russia, the Africa and the Russia, and to a very large extent, India and the Russia, and it's including Middle East, it continues. So how it's going to shape up, we are in unknown waters. So difficult to say how it would be, but given the both sides of the picture, prices are likely to remain 100 plus and within 120. Now we understand it's a very wide range, but those dire scenarios of $150 and $200, I guess the risk appetite does not really warrant that. And we would take a view that the volatility would remain between 100 and 120, unless something dramatic were to happen on the Russian invasion of Ukraine, which we cannot predict. So largely, yes, we do not know how things are going to pan out.
As you rightly said, we are in uncharted waters. But thank you for your time and your valuable insight on the crude industry. Thank you so much.
Pleasure. Thank you.